In today's episode, we are speaking to one of the most successful natural resource, gold, silver, and commodities investors. That is Rick Rule. And we're going to be talking about just that subject and how you can profit after what is going on right now in the economy with inflation, with money printing, and supply chain disruptions in natural resources as well. So make sure to hit the like button on this video to send it out into the YouTube universe so more people see it. Comment down below Rick Rule rules. Right there down below is his link where you can reach out to him and he will grade your natural resource stock portfolio for free right there down below. And shout out to our sponsor, Vizsla Silver, one of our favorite silver and gold mining stocks. Hello, Rick.
Jake, a pleasure to be with you again. Thank you for having me back.
Yes, it's great to see you. So I wonder, could you have envisioned a better environment for commodities and gold and silver 5 years ago, 10 years ago, 20 years ago, where this much money is being printed, there's this much underinvestment in the sector?
Jake, I have a very fertile imagination, and I've lived through two precious metals and commodities bull markets. So the answer is yes, but I believe in the sort of thrust of your thesis, which is to say, particularly with regard to precious metals, the wind is in their sails. And I can demonstrate that later in the discussion by a historical examination of prior bull markets. With regards to natural resources, it wouldn't surprise me to see them lag a bit, because remember, they're economically sensitive. And my own nervousness, I'm not an economist, but my own nervousness is that the economic conditions that we're enjoying now are probably more a function of artificial stimulus, which is to say liquidity, than any underlying strength in the economy. So I'm not disinclined to say that the economy might falter, and as a consequence of that, the rest of the resource complex might not go lower before it goes higher. Looking further out, for reasons that you and I have discussed in prior interviews, society's underinvestment in natural resources of all types over the last 20 years, I think almost certainly guarantees shortages 4 years out and 5 years out. The part I'm nervous about is 1 year out and 2 years out. And given that I'm not an economist, perhaps you can pass off my nervousness. But with regards to precious metals, I really truly believe that the wind is in precious metals sails.
You said that later on you can elaborate on the history of previous gold and silver bull markets. So why don't we go there now?
Let's do it right now then. First of all, I've been through two precious metals bull markets, real ones. I've been through smaller cycles, but I've been through two real bull markets, 1970 to 1981 and 2000 to 2011. Many younger people who haven't experienced bull markets say, Rick, this bull market's been underway for 3 years. Have I missed it? Is it over? Well, if history is any guide, these are decade-long affairs. So we're 3.5 years into a decade-long affair. People similarly say to me, Rick, the gold price has cleared up from $1,000 an ounce to $1,800 an ounce. Have I missed the boat? That's the dimension question. In the first bull market that I experienced, the gold price went from $35 an ounce to $850 an ounce. Which would suggest that a double isn't what one would look for. In the second bull market, which was perhaps more instructive, the 2000 bull market, the gold price went from $253 to some number around $1,900. So both in terms of duration and dimension, one would suggest that this bull market is perhaps 40% of the way through. But most people don't have decade-long memories or decade-long aspirations. Most people, when they look at this precious metals bull market, they don't note the fact that in this market, the gold price has increased from 1,000 to 17 or 1,800. What they do see is that the gold price has declined more recently from, $1,950 down to its current level. If you examine prior bull markets, and we'll refer later in this interview to the Barron's Gold Mining Index, which I think is the best way to look at gold equities over time, what you will see is that you can have a cyclical decline in a secular bull market that is of some dimension itself and some duration itself, that's in the long-term scheme of things, absolutely irrelevant. We've now been in a malaise, giving way to a decline in the prices of both precious metals and precious metals equities, of some dimension. I guess the equities are off 20% or something like that. A decline of this order of magnitude will happen probably twice more during this bull market, and it won't matter a bit. If you examine the gold price chart or the gold equities chart from the 1970 to 1981 bull market, you will see in 1975 where the Fed, in an eerily familiar fashion, allowed the interest rate to rise and the US dollar to strengthen. That cut the gold price in half. It had risen from $35 an ounce to $200 an ounce at the beginning of 1975. It fell from $200 an ounce to $100 an ounce. And people who got shaken out in that decline missed a move in gold from the end of 1975 at $100 an ounce to $850 an ounce in 1981. So I think it's important for people to understand the anatomy of precious metals bull markets, to understand that it isn't all up, to understand that it's very volatile, not just very cyclical. And you can have a cyclical decline in a secular bull market, and the bull market is intact as long as the reasons that caused the bull market to occur are also intact. And I believe those are very much intact. We've talked about them before, but let's go over them again for people who didn't listen to those earlier interviews. Quantitative easing. That's counterfeiting in English. It's a bad thing, but it's particularly a bad thing for the big thinkers because it ultimately diminishes confidence in the currency, and it diminishes confidence in the ongoing purchasing power of savings. Worse is debt and deficits. Debt and deficits work both to reduce the credit quality of the debtor, which is to say the US government, at the same time that they crowd out other seekers of capital to grow the economy. Then, of course, there's negative real interest rates. Gold competes with a wide variety of savings instruments, but when savings instruments pay less interest than would be accounted for by the depreciation of the purchasing power of the money saved, those instruments don't provide very good competition for gold. If you look at the arithmetic around the US 10-year Treasury, yielding right now 125 basis points, something like that, in a currency that they say is depreciating at 4.5% a year, which means that the government is absolutely positively promising that you will lose 3.5% of your purchasing power a year compounded for 10 years. They're telling the truth for the first time in your life, Jake. If you give them money now, they'll give you back less later. What's important about that is that nothing would diminish confidence in the purchasing power of savings as much as a guarantee that you would lose money in those products. Finally, there's the market share of precious metals and precious metals equities. At present, about 0.5% of the total value of savings and investment assets in the United States market is comprised of precious metals and precious metals related assets. The 3-decade median is between 1.5% and 2%. So I would suggest to you, Jake, that if quantitative easing continues, which I think it will, if debt and deficits continue, and I think they will, and if negative real interest rates continue, and I think they will, that the market share of precious metals and precious metals related securities in the US will, at the very least, revert to mean, which means that demand for precious metals and precious metals related assets in the US market would triple from these levels. That's what I think happens. And when I say it's important to think about dimension and duration in bull markets, it's important as long as the factors that contribute to it remain intact. And I think all 4 of those measures remain intact.
So, speaking of those measures in the previous market, you said that it declined by 50% from $200 an ounce in gold to $100 an ounce. And that was because interest rates rose and the dollar did as well. But then did it revert back? What were the larger factors that resumed the uptrend? And how does that parallel to right now, do you think?
Eerily similar, just all smaller numbers. The decade of the 60s was a boom time in the United States, and we thought we could do anything to anybody. So we took on, among other things, the war in Vietnam, which we lost, and the war on poverty, which we lost. This spending boom in the 1960s was the first real expression of lack of confidence in the US dollar, really since the Great Depression. And when the interest rates were allowed to rise, the impact on the economy and the impact on equities markets was pretty dramatic. When savings products yields increased, the dividend stream of stocks became less attractive relative to those savings products. And so the stock market fell. At the same time that economic activity began to decline because the interest rate on the US, on the 30-year fixed mortgage increased, while the prime interest rate increased too. Both Congress and the Fed, with the urging of US interest payers, which is to say citizens, lost their nerve, took the interest rate down. The US dollar became relatively less competitive against other currencies. And of course, both inflation and the gold price roared.
I've never heard someone refer to a United States citizen as a US interest payer. So, you are saying that this correction in the price of gold that has seen many people leave the market and say this is a dumb thing to be involved in, and has also led to more comments on my channels saying similar types of things recently as well. You are saying that this looks totally normal to you.
Absolutely. I mean, absolutely. Listen, Jake, actually, I'd love to be wrong. I'm 68 years of age. I'd like to live through 20 more years of a Goldilocks era. I just don't suspect I'm going to be able to do that. I've seen this movie before, but frankly, I've never seen it with the numbers as extreme as they are today. I've never seen, because we've never experienced on-balance sheet liabilities that exceed GDP. I've never seen off-balance sheet liabilities a fraction of where they are today. And I've never seen such broad-based complacency in the market with regards to what I believe is the misconception that liquidity is the same as solvency. It is clearly not. But I'm concerned about the fact that what concerns me, which is obviously fact, seems not to concern all those people that I walked by in the casino.
So the 16-cent drop in catch-up price that we heard from the politicians, that's not reinvigorating your confidence right now, I take it?
I like ketchup. I think that's wonderful. I juxtapose, that's a very good technique for them, by the way, for a few reasons. Most people don't want to be scared. Most people also don't want to take control of their financial future. Most people want the big thinkers to do it for them. They want to be protected by rather than from their politicians. Also, all politics is local and personal. People identify with a 16-cent fall in the price of a bottle of ketchup much more easily than they identify with on-balance sheet and off-balance sheet liabilities exceeding $150 trillion at society's level and trying to service that debt with a $4 trillion negative income. A politician who talks about the price of ketchup and says, don't worry, be happy, will always outpoll an old, fat, bald, white guy who can add and subtract.
Okay, so now how about I want to talk about other commodities. I want to talk about silver, but let's go to uranium first. So, Sprott, Uranium Trust, just kind of getting solidified here. Give us your opinion on the uranium market.
I think Sprott is going to impact the uranium market.
Really?
I honestly do.
Really?
We've been, I can't say we anymore. As you know, I'm no longer an employee there, although I am a director. We have been trying to take control of the management of that product for a very long time.
How long is a very long time?
3 years. And I think that Sprott's controlling the management contract, provided that we are successful, as I believe Sprott will be successful, in listing that on the New York Stock Exchange, will make a difference. We have about $12 billion in assets under management in our other physical products, gold, silver, and platinum, and palladium. And we have that on behalf of over 250,000 investors. And I think that we will be successful in introducing some number of those 250,000 existing Sprott customers into the uranium narrative. Right now, that product controls 19 million pounds plus or minus of uranium. And if we are able, as I think we will be over a couple of years, I shouldn't say we, it's not me, it's Sprott. If Sprott is able, as I believe they will be, to triple assets under management in that trust, we would take 35 or 40 million pounds of uranium out of the available for sale category and put it into the held category. Think of the Sprott Trust itself as being 40 nuclear power plants. Will this happen in a month or 2 months or 3 months? No, I don't know how long it'll take us. It'll take us 4 or 5 months probably to be accepted for listing on a New York Stock Exchange, because there's never
4 or 5 months from right now.
Yeah, I mean, there's
Okay.
never been a product like this in the market, and the SEC likes us from our physical trusts, but they have to examine the implications of this trust for investors before they approve of it. And the rest of the uranium market is beginning to be in better shape from a whole bunch of perspectives. The low carbon green narrative has done more for perceptions around uranium in the last 12 months than anything I've ever seen. People around the world are accepting that consumption of electricity is going to increase both because people of your demographic, wealthy young people, would like to drive electric vehicles, which is good, but also increase because there's 1.2 billion people in the world that don't have access to electricity, want it, need it, and they're going to get it. And supplying that electricity, at least the baseload part of electricity, will require all forms of energy. Nuclear has the advantage of being very good baseload energy while generating no carbon whatsoever. And interestingly, you may recall on earlier interviews, Jake, when I said the pace of the increase in the uranium price will be a function of the pace of the increase in the restart of the Japanese nuclear fleet. The nuclear industry has been unpopular in Japan since Fukushima, both because of Fukushima and because the Japanese electorate believed that they were misled by their government around nuclear power. And so although the government wanted to restart the plants, the politics of restarting the plants was problematic. There has begun to be a sea change of opinion in Japan around nuclear power because it's suddenly perceived as green. And while the underlying strength in the uranium market was the pace of Chinese new construction, what is happening now is that the new green credentials of uranium, I think, will allow the pace of Japanese restarts to begin. And that's important because the most important inventories in the world are Japanese inventories that are held by reactors that aren't running. And if you take that inventory away from available for sale and it becomes fuel, you have suddenly gone from a market that is in surplus to a market that is in uh, harsh deficit. This could easily take a year and a half or 2 years more, but it doesn't need to now. If you begin to have restart announcements in Japan, the term market changes because reactors won't be able to lock in forward supplies in the term market. Pardon me. They won't be able to lock in prices on the spot market. They'll have to go to the term market. And the term market strength by itself will strengthen the spot price. If you add that to the probability, I think, that Sprott will be able to list on the New York Stock Exchange and rapidly grow assets under management, and hence rapidly take spot market reserves out of the market, I think you are at the place now where all of the catalysts are in place for an increase in the uranium price.
I've been covering uranium a lot. Obviously, there's a high interest, but there's less of an interest than there is in gold and silver itself. But we've been covering it a great deal. Do you believe that Sprott getting involved is overstated or understated?
Understated. I don't think enough people understand the uranium market, and I don't think that a lot of people understand what I consider to be the probability that Sprott by itself can mobilize large numbers of investors and effectively sterilize a lot of inventory.
And when you say that it's understated, how has your views on the potential of the uranium market changed since this has moved into action and the seemingly imminent New York Stock Exchange listing as well, knowing the amount of supply out there? I mean, to me, I'm just some random guy on the internet, but it looks like they smell blood in the water. And between their contacts and all the buying that happened in mining stocks, they really know that this market could move quickly.
I don't know about quickly, but I think it moves certainly.
Got it.
Which is important. I believe, too, as we've talked about before, that the uranium juniors have anticipated much higher prices. If you look at the universe of uranium juniors relative to a $32 or $33 uranium price, they are insanely overpriced. I think right now the uranium juniors are probably discounting $45 uranium. So in terms of putting the discussion that you and I just had into practice, you need to be very cautious. If we see the uranium prices that I think we're going to see, it's not much of a stretch to see the uranium juniors triple from here. But it also isn't a stretch to see them fall 35 or 40% first. People are very impatient when they should be somewhat more patient.
Understood. So how do you size up uranium versus gold, silver, and other commodities in the near, I'm not talking decade, let's talk the next few years?
Jake, it depends on for who. The uranium juniors are a superbly speculative endeavor. And people who speculate need to work hard. They need to manage their emotions. They need to manage their time preference. If somebody comes to me with all that intact and somebody is willing to suffer a year or a year and a half of pain, and they're willing to construct a 5 or 6 stock portfolio, not put all their money on one horse that has a good name or something like that, I think I can say to them that if they are prepared to stomach lots of cyclicality and lots of turmoil, that they should get, 3, 4, 500% gains over 5 years. Most people talk a big talk. They say, "Oh yeah, that's good. I'm in. I'm tough." And then the index falls by 10%, and all of a sudden, like Mike Tyson said, everybody has a fight plan until he punches them in the mouth. That's the way people are about markets. If more people regarded sell-offs as sales, that is, if they had some sense in their own mind what something was worth, and they viewed the fact that it declined in price as being of benefit to them, so that they could employ the same intellectual capital at a lower price, they would be better. With regards to gold, I think not owning physical gold is a mistake. In other words, I think not owning gold is a speculation in and of itself.
Hmm.
If you don't own gold, what you are is speculating long government. And I think that's a really shitty bet. So I take gold, physical gold ownership out of the speculative category and I put it in the insurance category, the savings category. The gold stocks, one must work harder on. They are either investments, depending on what style of stock you buy, or speculations, depending on what style of stocks you buy. And as I said on your show probably 70 days ago, the mid-cap gold stocks are, by most objective valuation methodologies, as cheap as they've been in my career. Gold stocks, in fairness, are never absolutely cheap. They can only ever be relatively cheap because people buy them for the upside of the metal. But they are relatively as cheap as they have ever been in my career. And that's based on the current gold price. If you look at their net present value relative to their enterprise value, calculated at today's gold price, and then you overlay what I think is the strong probability of a higher gold price, I can make a case. Well, I can't make a case against physical gold ownership. I can't do it. But I can make a strong investment case for the better gold equities. I can make a weaker speculative case for the junior gold equities because that part of the market is, by and large, too frothy right now.
So,
Go ahead.
other than gold, silver, and uranium, give us some commodities or natural resources that you think look attractive or you think are underlooked.
I think platinum is probably attractive. In the stock market, the assets that still seem to me to be cheap are oil stocks. If oil can hold above US $60 a barrel, which is to say, if we don't have another COVID-induced lockdown, shutdown of the transportation industry, on a price cash flow basis or on a net present value to enterprise value basis, the oil companies are cheap. They've run a lot, but remember the oil price when they were depressed was at $20. If you ran a net present value at $20, the oil industry was broke. If you run a net present value at $60, the oil industry makes an awful lot of money. So I would say that the cheapest sector that I'm familiar with is probably the Canadian mid caps, or if you have the courage, the big Russian senior producers, where you take an overlay of political risk. But the truth is that I suspect if you don't think that the economy is going to really run off the rails in the next 5 years, that an investor, not a speculator, but rather an investor, could buy Exxon and Chevron and enjoy 5 years of very healthy dividend yields and end up with a substantial capital gain too. I realize that people don't tune into your channel to learn about Exxon and Chevron, that they want to work a little harder, take a little more risk, and come down the quality trail. I'm only pointing out that that sector, the oil and gas sector, from top to bottom is quite cheap relative to what I think oil and gas will be selling for over the next 5 years.
So, if you want to if you're a speculator in commodities or mining stocks, whether it's gold, silver, uranium, oil, platinum, you name it, copper, the list goes on and on. And you're looking at right now, like one of those moments in history where there might be a great opportunity for some quantum leaps in your net worth. Give us some of the most important speculator principles.
Well, the speculator principles, I think, first of all, are tenacity. You can be absolutely right about the fact that something's going to occur, but it can take longer for it to occur than you might be prepared to endure. I used to give a talk years ago, Jake, about the difference between inevitable and imminent. And so often, speculators have got the big picture right, but they've got it right before society has. And the trends in motion continue in motion in a way that they haven't foreseen for longer than they have the emotional wherewithal to endure. If something absolutely positively has to happen, it will happen, but it might not happen on your schedule. So don't get shaken out. Invest an amount of money that you can afford to, at least temporarily, be down 30 or 35% on. This is extremely common in speculation. I think I said in an interview I did with you that investing in Ross Beatty's various companies, I probably enjoyed 10 baggers over 30 years. And there wasn't one 10 bagger that I enjoyed that didn't take 5 or 6 years to mature. And there wasn't one that didn't expose me to a 50% decline in share price before I enjoyed my 10 bagger. And I think those are very, very, very instructive lessons. One makes money as a speculator by identifying a circumstance before one's competition does. In my case, often 2 years before the competition does. And I have to endure both time and volatility in order to reap the rewards that I've enjoyed over 35 years.
So let's talk about that psychology a little bit because we're seeing that a bit. You've seen a bit of that in gold and silver and uranium and copper. You're seeing it in a lot of the small stocks as there's some fear of, is there going to be another market crash and whatnot. So I think that for me, one thing that's really helped me was what you said was amount of money that you can afford to be without and have it down 30-40%. Another thing for me is I just don't even look. I know where it's going to go and I'm fine if it takes however many long. Is there any other important things with regards to that psychology when you see a 30% drop?
Well, Buffett said a couple things that are instructive. I realize that Buffett is, hopelessly old and stale for your generation. But remember, the guy's made 60 or 70 billion dollars as an investor or speculator. He's still worth listening to. He says a couple interesting things. He says that you shouldn't buy a share of stock if you wouldn't be delighted to own the whole company if you could afford it. In other words, if there's 100 million shares out and you buy one share, you better believe that if you were able, you would buy every share at that price, own the whole company, take it off the exchange, and own it privately. That goes to the discrepancy between price and value. Buffett will tell you that money is made on the delta between price and value. The second thing he says is more instructive for young speculators. You shouldn't buy a share of stock unless you know the company well enough that you would be absolutely delighted to see it fall in price by 30% the month after you bought it, so that you could apply the same intellectual capital that you already spent and more physical capital. In other words, if you bought something for $1 and you thought it was a good deal at $1, you better love it at 70 cents. Because if you don't love it at 70 cents, you didn't know enough to buy it at $1. And I think that's probably the most important advice that I could give novice speculators.
Okay. So is there anything else I'm missing? If I want to get rich investing in commodities and metals and uranium right now, what else do I need to do, Rich? What else do I want to, what else? I called you Rich. I meant to say, what else do I need to do to get rich, Rick? So if I want to be Rick Rule Rich, what do I need to do?
First of all, understand it'll take time. It's odd that at 68 with less time on earth, I've become more patient. It really, truly is odd. But that's what it takes. I made a lot of money, as I've told you early in my career. And the consequence of making so much early is that I didn't understand enough about money and I lost it all. Once I came to understand the way the process worked and how value is added, I became a much better investor. And it took me a decade after my fall to become really rich again. But it took a decade. uh, circumstances where the ordinary speculator, somebody who doesn't build their own business, uh, can enjoy 50 or 60 fold increases in their net worth in 2 or 3 years are excruciatingly rare. Really, truly excruciatingly rare. Perhaps in the recent crypto markets, there were some examples of that. But I think the very rarity of the example proves what I said. I believe that the precious metals bull market in front of us has somewhere between 5 and 7 years to run. I wouldn't expect to make 100% compound annual rates of return unless you're prepared to work very hard and be very lucky, and unless you're prepared to wade in with both feet if that market declines by 30 or 40%, which it might. But I certainly would be, I certainly would not be surprised if somebody could generate 35 or 40% compound internal rates of return for 4 or 5 or 6 years with a high probability of it coming to be true. Those are those are really good circumstances. Um, really good circumstances.
Okay, so as we wrap up, what else does one need to do to get rich right now?
Well, getting rich requires that you do one of two things. It requires either that you start your own business, which is the surest way to get rich that I know, but it's not appropriate to most people because they can't or won't or something like that. The second is that you become a capitalist. And to become a capitalist requires, Jake, requires that you have capital. The first step for most young people is to save. Most young people, I'm not talking about today's young people, I'm talking about young people throughout my life, have forgotten to save. They've actually earned in order to spend. People say, I can't save. Oh, really? No beer, no wine, no Starbucks, a car that runs as opposed to a car that impresses girls or boys. I'm an old fat rich guy. I shop at Costco. Okay. So discipline, disciplined savings. If you want to be rich, don't want to live rich. Be rich before you live rich. I would say that that's the most important lesson. At a minimum, save 10% of your income pre-tax. 20% of your income pre-tax is better than 10% of your income pre-tax. In fact, it's more than twice as good because it gives you more opportunity. Can't afford the rent on a 2-bedroom? I got it. Get a roommate. You don't want a roommate? So what? You think what you want matters? Not if you want to be rich.
So I thought that was interesting that you said 10%, then you kind of corrected it or updated it. And I'm wondering your thoughts on saving percentages because I read all when I was like in my early 20s and I decided I didn't want to be broke anymore. I started reading money books and they all said to save 10%. Then I pulled out a calculator and I did the math on it. And I was like, I'm going to be rich in like 7,000 years. And so I moved it up. And with devaluation of currency, what do you think?
If what I want is for somebody to start savings. And if they start saving at 10% and they see how easily they can do it.
Okay.
If you give up Starbucks, if you give up fancy shoes, 10% is easy.
So it's the habit itself?
That's right.
Got it.
10% of every paycheck pre-tax. Pay yourself first. You don't get to do anything else until you put the money aside. You don't put the money aside with what's left over. Everything you spend is what's left over. You save first. What you learn, by the way, when I was in university, I managed to save 50% pre-tax. Now, in fairness, that meant that I hitchhiked as opposed to take the bus and stuff like that. I mean, that was a bit extreme. But certainly, if I could do 50% pre-tax while I was a university student, somebody who is gainfully employed can do 10% now. And take that 10% and work it. It isn't enough in investing just to invest money. You have to invest time. You have to understand something about your investments, and you need to prepare your mind to be a better investor. The idea that anybody who's listened to our interviews in the past, Jake, that hasn't read The Intelligent Investor, as an example, that hasn't read Economics in One Lesson, this is silly. These things are free. And working on your mind at the same time that you work on your bank account is, I think, a precondition for getting rich. I know that what your listeners want is a 10-cent stock that's going to go to $10, and they want it to happen by Christmas. But they need to understand that's not on offer. That's not the way one gets rich.
So I started saving 10%, and that habit helped. Then I heard Sir John Templeton say 50%, and I started to try to do that, but I didn't have enough money to do that. And then it made me realize the next thing that you were just teaching me, which was having a business, because I realized my problem was really that I didn't make enough money. Why do you say that about a business being a necessary prerequisite?
Well, the surest way to get rich,
Okay.
if you can do it, is to own your own business where you sell a product rather than sell your time. That's not appropriate for many people. Many people don't have the temperament to be business owners. Many people have things in life that are more important to them than money. They want the money to afford the other things. And that's fine. If what you want to do is allocate 40 hours a week to fund your lifestyle, that's great. But that's not how you get rich. I'm not suggesting that everybody should want to get rich. There's all sorts of non-material riches. And some of the absolutely happiest people that I know are people who are comfortable as opposed to rich. And then they have no particular desire to get rich. They just want to live well. That's all fine. You asked me a different question. You asked me, how do you get rich? And getting rich involves sacrifice. Part of the sacrifice, if you're willing to own your own business, is that most of the rest of your life, as you know now, Jake, gets supplemented from time to time to your business.
So how do you become more disciplined?
Well, sadly, age helps a bit. I was a wild speculator as a young man. The consequence of that is that I made a very large amount of money very quick, and I lost it just as quickly. And that taught me a lot. It really did teach me a lot. Some of the discipline came from, getting the rough edges that many young men have knocked off me rather forcefully.
So when you say that you were a wild speculator, do you mean that, like, essentially you went all in, you did not care if something went down 30%, you were in, you weren't going to get talked out, and you just went all in like that? Is that what you mean? You had a very high risk tolerance and stomach for it?
I had a high risk tolerance, and when I experienced success, I came to believe that I was smarter than I was. I made my money in a period of time where the oil price went from $2 a barrel to 30. Natural gas price went from 30 cents to decontrolled gas as high as $15. And somehow I mistook that bull market for my brains. So that was one mistake, hubris. Easy for a young man to make that mistake. The other thing I did is borrow money. And so when you looked at my balance sheet in the latter part of the decade of the 1970s, what you found was a balance sheet that had a lot of ascribed equity, which is to say the price of assets that I owned had risen a lot. And I took on a lot of leverage that worked great at $25 oil, but it didn't work at all at $12 oil. As it turned out, my income was variable, but my expenses weren't, which is exactly the wrong way to have it.
Interesting.
Yeah, it was interesting. And I'm delighted to say I navigated it. I paid back every dime I borrowed, principal and interest, which took some doing. I'm not trying to say that I did it on as timely a basis as my creditors would have preferred, but they did like getting the money back. which set me up well. And I learned very valuable lessons. I learned that markets work. We've said this before in your show. The cure for low prices is low prices. In other words, bear markets cause bull markets. The cure for high prices is high prices. I forgot in the decade of the 70s that markets worked. And I got a very, very, very vicious lesson in precisely that. So a lot of my discipline has to do with looking at the world through fairly heavy scar tissue.
What does sacrifice mean to you? You said that phrase, and how does one do it?
When I say sacrifice, it hasn't been a sacrifice to me because there's not much stuff that I want. I mean, I like giving money to philanthropy. That's a consumer good as far as I'm concerned. That's probably my largest expense. But for many people, they feel differently than I do. Many people, when they go to a restaurant, want to be able to treat their friends to a $200 bottle of wine. For me, usually the utility in anything over $50 a bottle is lost on me. So buying the $200 bottle of wine, if it makes my guest happy, that's okay. But for me, I mean, I live in an extremely nice house, as you can probably see in the back. But early in my career, the sacrifices involved things like driving a Toyota pickup truck when other young men in particular aspired to automobiles that young ladies might like more, as an example, or various consumer goods. The other sacrifice is that I've worked extremely hard. Now, for me, that hasn't been a sacrifice because I've loved it. I mean, I've really, truly loved it. But if you look back in my life, there were an awful lot of 70-hour weeks. There were some 90-hour weeks. There weren't very many 40-hour weeks. And there certainly weren't very many 30-hour weeks. So if you are going to get ahead financially, you aren't going to do it by working the same number of hours or at the same pace that your competitors are. Most people don't get rich, and in order to get rich, you need to outperform most people. You do that by working harder, smarter, and longer, which entails a sacrifice. It might be that what you'd like to do is, go play softball with your friends on Saturday. The problem is that you have 12 hours worth of undone work, which is going to consume your Saturday. I'm not saying that you should not do the softball, but you should not do the softball if you want to get rich.
So, Rick, I appreciate our time today. I think that we covered and hit the nail on the head. And I want to ask one final question. So, give me any piece of advice that you feel like I've missed, or a topic that I've missed for someone that is investing in these sectors, given this moment in time right now.
This isn't, well, I'll give you two. One, I guess, specific advice: don't ignore the high quality silver stocks. Silver usually outperforms gold in the back half of a bull market, and I think we're coming to the back half. Whether it's going to be here 6 months from now or 12 months from now, I don't know. And silver outperforms, the silver equities outperform the silver. So if you believe in the precious metals thesis, it's time to take a little more risk. Everybody else is shedding risk, so you do the opposite of what everybody else is doing. As we've discussed before in your show, Jake, the silver equities are extraordinarily volatile. And when the narrative around precious metals gets to the point where people are buying it for greed rather than for fear, the market capitalization of the decent quality silver stocks is so small that when the generalist money comes into them, the market caps can't contain it. So speculators who believe in the precious metals thesis should begin to look at the silver stocks. Could they go lower before they go higher? Absolutely. But the second thing in terms of general wealth is most people need to read more. Knowledge can't be taxed, although the benefit of it can. It can't be stolen, although some people lose it. Most people don't spend enough time learning how to invest and speculate. And that knowledge is absolutely free, except for the time you spend getting it. So I would say that where most people fall down is preparing themselves in terms of acquiring knowledge and then learning how to apply the knowledge in a rational process to speculate.
Well, we thank you very much for helping us educate ourselves and continue to follow on that journey. So, for everyone listening to today's episode, give us a comment down below that says Rick Rule Rules. Right there down below is Rick's link where he will, for free, assess your natural resource, gold, silver, commodities, mining stock portfolio. Link is right there down below. Make sure you hit the like button and the bell notification to get notified for new videos. Bell notification is what notifies you for future episodes. So make sure you tap that. And Rick, any last words?
Well, simply to reiterate, I'm delighted to review people's natural resource portfolios personally, rank them 1 to 10, comment on those issues where I think my comments might have some value. And if you include in the question and comment section charts, I will send along with my rankings the Barron's Gold Mining Index, which is the best visual representation of gold equities markets going back 50 years. And in addition to that, I'll send a 100-year chart showing commodity pricing relative to the pricing of other major asset classes in the economy going back 100 years.
So we'll link that right there down below. We want to thank you for watching today's episode. Give us a comment down below, and we'll see you next time.